Good evening, everyone. Allow me to introduce myself. I'm Kerry Given. I'm the founder of Parkwood Capital, a firm devoted to training people just like you to be able to manage their own stock and options portfolios. I got the nickname Duke when I was a boy, and it stuck with me, and so that's where part of my Dr. Duke moniker comes from. A lot of my students call me Dr. Duke because I earned a PhD in chemistry several years ago. I published my first book in 2011, entitled it No Hype Options Trading. And the reason I gave it that title is because I was annoyed with some of the excessive marketing hype that you often see in the financial arena. I met Dr. Singh earlier this year at a trading conference, and we ended up having dinner together and getting to know each other. And one of the things we discovered is that we were on the same page in terms of offering no hype to our clients. And so Dr. Singh has asked me to develop a customized option coaching course just for his clients. And one of his unique trades that he brings to the table is what he calls the four-legged strategy. What I'm going to do tonight for this brief tutorial is discuss the four-legged strategy and give you a sample of one of those trades. And hopefully this will give you not only an idea of one of his strategies, but also an idea of the quality of coaching that we're offering Dr. Singh's students. First of all, let's explain what a calendar spread is, because the four-legged strategy is actually an innovative approach combining a couple of calendar spreads. We create a calendar spread by simply selling the front month option, could be a call or a put, and then moving out to the next month and buying that option at the same strike price. But again, either a call or a put. If we do this at the money, meaning that we choose the strike price to be very close to the current stock price, then this is a classic sideways trade. We'll profit as long as the underlying stock basically trades sideways. We can move that call calendar up, build a call calendar up above the stock price, where we sell the front month option, or sell the front month call in this case, and buy the next month out call at that strike price up above the stock price. And this is a classic bullish play. If the stock price trades up toward our calendar, that calendar will become much more valuable. We can do the same thing using put options and positioning it down below the stock price. A double calendar spread combines those two trades and gives you a broad window of profitability. In other words, it's still a sideways trade, but it's a broader window that we're profitable within. Now, the four-legged strategy combines an at-the-money call calendar with an at-the-money put calendar. It's truly a unique combination that I'd never seen before. The example I'm going to talk about is on Kerx Biopharmaceuticals. The ticker symbol is KERX. And on Saturday the 23rd, Dr. Singh recommended this position, and Kerx had closed on Friday at $7.10. So on Monday the 25th, we sold 2 November $7 calls and 2 November $7 puts, and bought 3 December $7 calls and 3 December $7 puts. So in effect, what we've done, we've sold 2 November calendar spreads and bought 3 December calendar spreads. Now, this position required an investment of $239, and the break-evens initially were at $6.55 and $7.69. But as you'll see in a minute, that can widen and actually get more favorable with time. Our maximum loss is limited to $56, but the gains could easily be over 100%. Here's our risk-reward diagram for this trade. On the left-hand side, we have the stock price. As you can see, it's right here at about $7.10. On the right-hand side, we have the risk-reward diagram. This black line is the profit and loss at all different strikes or all different prices of Kerx. So you can see if Kerx is trading at $7.50 at expiration, your profit would be roughly $18, or about 10%, a little under 10%. And so this gives our profit at different places. The maximum loss is right here, as you see, when it comes down to $6 and maybe got a little larger, but that would probably be the maximum loss that we would have. But as you can see, the upside is significant. If this stock trades higher, we can make a fair amount of money. As of today, October 24th, this strategy stands at a net gain of $44 per trade. Our original trade of $239. We're now up $44. We could close it today for a gain of 18%. Now that's in spite of the fact that look at what's happened with it. Carex has actually traded down markedly. It closed today at $5.79. And yet we stand out here where this red line is. That's today's value. And so we're up about 44 bucks. And if it bounces and goes much higher, it wouldn't have to go too much higher, we could make a lot more money. Now, I'm not sure. We still have about 3 weeks to go before November expiration, so I'm not sure where Dr. Singh's going to call this. But he could close it here in the next couple of days for a small gain, or he could allow those November options to continue to decline in value, and that would probably increase the profitability of this position. So in summary, what you have in this particular example of a four-legged strategy is how innovative a lot of Dr. Singh's trades are. But also you see that they're very conservative. He set up this trade in such a way, these December put calendars severely limit the loss if the stock price declines, and that's in fact what's happened so far. Yet these call calendars are set to make a lot of money if it trades higher. And this turns out to be pretty typical of Dr. Singh's strategies. There's always a good downside protection. This is only one of several unique options trading strategies that Dr. Singh offers his clients. And our coaching course will cover this trade in much more detail, as well as all of the other trades that Dr. Singh recommends. I hope to see you at our next course on Dr. Singh's option trading strategies. Until then, you are leaving the no hype zone. Be careful out there. Good night.